One morning in May of 2024, about 100,000 Americans opened their banking apps and found nothing. Not a smaller number, nothing. They hadn't been hacked, the market hadn't crashed, their banks were open, solvent, fully insured. And $265 million froze anyway. When the counting was finally done, as much as 96 million of it was simply missing. One man had $15,000 saved. The first payout gave him back 75 cents. 75 cents. This is the story of the company you've never heard of that sat underneath the apps you have, and what happened when it simply switched itself off. To understand how 100,000 people lose their savings without a bank ever failing, you have to start with the promise. In the late 2010s, a wave of financial apps appeared with a simple pitch: banking, but better. No branches, no fees. Slick apps with names like Yada, Juno, and Copper. Yada's hook was genuinely clever, a savings account crossed with a lottery. Every $25 you saved bought you a weekly ticket. Prizes ran up to $10 million. Saving money felt like playing, and tens of thousands of people, many of whom had never managed to save before, started stacking every spare dollar into it. And everywhere you looked, the same four letters: FDIC, Federal Deposit Insurance, the full faith and credit of the United States government. If those words are on the label, your money is safe, right? Here's the thing. Those words were technically true. The banks behind these apps really were FDIC insured. What almost nobody understood, because nobody was paid to make them understand, is exactly what that insurance protects. It protects you if the bank fails. The bank. It says nothing about what happens if the company keeping track of whose money is whose fails instead. Because Yada wasn't a bank. Juno wasn't a bank. None of these apps were banks. Between them and the actual banks sat a company almost no customer had ever heard of. It was called Synapse. Founded in 2014 by a young engineer named Sanket Pathak, Synapse sold something called banking as a service. The pitch to startups? Don't spend years getting a banking license. Plug into us. We connect you to real, licensed, insured banks. You build the app. We'll handle the plumbing. Investors loved it. Andreessen Horowitz, the biggest name in venture capital, led a $33 million round. At its peak, Synapse connected roughly 100 fintech apps to a network of partner banks. Millions of end users, billions of dollars flowing through, and nearly all of it pooled into something called FBO accounts, for benefit of. Giant communal buckets at the partner banks, holding thousands of customers' money mixed together. The bank sees one huge account. The app shows you your personal balance, and the ledger that says which dollars in the bucket are yours. That ledger lived at Synapse. Only at Synapse. Which brings us to November 2022, and an email you were never supposed to read. A controller at Evolve Bank, Synapse's most important banking partner, wrote in an internal message, later cited in court records, that the balances, quote, tend to differ a couple hundred million on the daily. A couple hundred million. On the daily. 18 months before the collapse, the plumbing already didn't add up, and the water kept flowing. And one more crack, confirmed by regulators only years later. In October of 2023, Yada, the lottery savings app, moved its customers' accounts out of the bank entirely into a Synapse brokerage subsidiary with no FDIC protection at all. California investigators later found Yada did this while holding, quote, serious concerns about Synapse. The safest-sounding app in the pipeline had quietly become the least protected thing in it. The first big crack had come even earlier, in September 2023. Mercury, a business banking app that was Synapse's largest client by far, walked away, taking its business straight to Evolve and moving more than $3 billion in deposits out of Synapse's pipes. By December, Mercury and Synapse were fighting in private arbitration over tens of millions. Synapse's revenue was collapsing. Layoffs followed layoffs. And the whole time, the question nobody outside the industry was asking: if the middleman dies, who's holding the list? April 22, 2024. Synapse files for Chapter 11 bankruptcy. There's a rescue plan. A payments company called TabaPay will buy the assets. For 2 weeks, the plumbing keeps running on hope. May 9th, TabaPay walks. And then, on the night of May 11th, in the middle of an escalating standoff with Evolve over who owed whom, Synapse shut off a critical transaction processing system. No warning, no wind-down plan, no backup ledger handed to the banks, just off. Overnight, the banks were holding hundreds of millions of dollars in communal buckets, with no reliable record of whose money was whose. So they did the only legally safe thing. They froze everything. More than 100,000 people. Nearly $160 million locked at the freeze, out of some $265 million across the network. Emergency funds, wedding funds, down payments, kids' savings. For weeks, then months. The bankruptcy judge appointed a trustee to untangle it, Jelena McWilliams. And here the story turns darkly ironic. McWilliams used to run the FDIC. The former chair of the agency, whose 4 letters everyone had trusted, was now the one explaining, in filing after filing, why those letters didn't apply here. No bank had failed, so the insurance never triggered. The safety net existed. The fall just happened. Beside it. Then her team counted the money. Between what Synapse's ledger promised and what actually sat in the banks, the gap ran as high as $96 million. Regulators examining one partner bank put the discrepancy at roughly $92 million. To this day, no complete accounting exists of where it all went. Yada has alleged in court that nearly $30 million was drained from customer buckets over the years as fees. When the first partial payouts finally came, Yada's numbers told the story in one line. 13,725 customers, $64.9 million deposited, offered $11.8 million back, 18 cents on the dollar. That man with 15,000 saved and 75 cents returned? He was one of them. So, who paid for this? Take a guess. In November 2025, 19 months after the freeze, the judge dismissed the bankruptcy case entirely. Synapse had no money left to distribute and no buyer for what remained. The company that lost the list simply ceased mid-sentence. Its final act was paperwork. That same month, the government did something it had never done before. The Consumer Financial Protection Bureau took $46 million from its penalty fund, money collected from other companies' wrongdoing, and paid it out to Synapse's victims. The first payout of its kind in American history, funded not by the people responsible, but by fines from everyone else. Even then, many customers remain short to this day. And Yada? Fined $1 million by California regulators for telling customers their money was FDIC insured when it wasn't. And Sanket Pathak? 3 months after the freeze, while 100,000 people were still locked out, he announced he'd raised $11 million for a new startup, humanoid robots. By the following spring, he was reportedly pitching investors on a $100 million round at a $1 billion valuation. No criminal charges, though a federal investigation remains open, and a civil lawsuit filed this spring names him in an alleged racketeering conspiracy. An allegation, nothing proven. No ban from the industry. A fresh start, priced at $1 billion. Here's the one editorial sentence you're owed. The system didn't fail on May 11th. It worked exactly as designed. Because nobody had designed anything for the space between the apps and the banks. In September of 2024, regulators proposed a rule requiring banks to keep their own ledgers of who owns what. As of today, it still hasn't been finalized. And tonight, millions of Americans still hold balances in apps that are not banks, protected by insurance that answers a different question than the one that matters. The plumbing hasn't changed. Only the names on the apps have. Next, a company that convinced 15 million people to mail it the most private thing they own, their DNA, then went bankrupt and put it up for sale. That story's stranger than this one. It's next.